Hello and good afternoon, friends. I'm excited to come to you today with one of my favorite humans and Hinger, Taylor Leapart, with my very favorite geeky subject, how to value your company and your real estate and what that might mean for the future of your organization. So thanks for joining. We're thrilled to have you. We would like to say from the very beginning that valuation is complicated and it's much more of an art than a science. There are many factors that go into the production of a legitimate valuation. Valuation is something that the Hinge team does as a complimentary service for the community. So if you're ever interested to know what your company is worth, whether you're growing or you're considering selling, then the team at Hinge is happy to support you with that. I will pitch over right now to Taylor Leapart so you guys can say hi and ask Taylor to let you know a little bit about himself and his work at Hinge.
Absolutely. Thank you so much, Kathy. I'm very excited to be talking about this content because this is what I do on a daily basis. So it's really nice to get out of the numbers for a chance and have a little bit more of a discussion about what we do from a valuation perspective. But a little more about me. I started my career on the M&A background for mainly hospitality assets through a private equity firm right out of college in 2017. Spent about 5 years there, and then came on with Hinge, and happy to be on the sell side for a little bit more of a different perspective. So new into the childcare industry, but very excited to be a part of it. I've already seen the incredible growth that you have experienced over the last several years, and the demand in the industry is unmatched. So I'm very excited to be a part of Hinge and as well in this industry as well. So excited to get into the content, but I'll let Kathy go over a couple of housekeeping things and then we'll get started.
Thanks so much, Taylor, and appreciate you being here and helping our guests here understand the work that you do and the process it takes to really know what a company and its real estate is worth. So thank you for that. You guys, as we go along, please feel free to put questions in our chat box. We'll be monitoring those and we'll take as many as we can as we go. Also, we'll save time at the end to be sure that we understand where you guys are and what you're thinking and what your questions are, and give you a good overview of this process. Also, our team will make these slides available to you so you can use these as a reference. If you have questions in the future, that's what we're here for. So please reach out and we'd be happy to answer individual questions. So a couple of things to let you guys know. So from a big picture perspective, this is our wonderful Hinge team right here, minus Jacqueline, I think, because Jacqueline was on maternity leave, but most everyone else from our most recent Shift conference in Salt Lake City last year. We are launching our registration for this year's conference in Charleston, South Carolina for our 20th anniversary on Friday. So look out for that. That will sell out quickly. We'd love to see you guys there. So mark that down. Be sure that you get on our website and get yourself registered. We do, as we indicate here, perform valuations on behalf of the industry. We do a lot of teaching, a lot of services to support your financial health. And that's, we feel like there are not a tremendous amount of resources available to our industry and how to be financially healthy, how to become as strong as possible, because remember, this is my preachy self because I say this a lot, but financial strength and providing excellent services for children and families are not at odds with each other. they're necessary for each other. So you can't possibly do the mission that you got into this business for unless you're as financially strong as possible and taking care of yourself. That's not just okay, it's mandatory. So our mission is to help you be as strong financially as possible. And when you're ready, we're here with a very active buyer list, the strongest buying environment we've ever seen in our 20 years, my actually 38th year in the industry. And the basis of our work is to help people sell their company and their real estate when they're ready. So you guys plug into some of our training because we're here to help support making you the very best that you can be. I like to mention a new service at Hinge. In addition to some of the training services, we perform leadership sprints through our coach, our certified coach, Tom Wood on the Hinge team. Many of our clients have taken advantage of this since we launched it in January, and the results have just been fantastic. It's really difficult to describe the impact of this 30-minute weekly coach-led leadership content on your team, which also includes feedback for your managers. The Hinge team went through it last year, and it was so powerful that we added Coach Tom to our team so that we could make this available to other clients and childcare groups. So reach out if that's of interest. Please join us on social media. We announce a lot of things there, opportunities like this. You guys are probably plugged in because you're here, but opportunities like this, our conferences, our Thrive financial deep dives and webinars. So join us on social media. We're going to jump into the content now. So the first thing that I want to talk about is what are the factors that affect the value of your company, both inside or internal and external factors. So these are the things to pay attention to. First of all, you want to spend wisely. You don't want to waste money, but also you don't want to underinvest. Potential buyers and potential investors are equally concerned about underspending in categories as they are overspending in categories. And I like to direct people to our free benchmarking app online at frameworkbyhinge.com. There you can input your school's license capacity and its average tuition rate, and you will get populated a line-by-line financial benchmark that will show you what the average school in your size group, given your tuition rate structure, would spend in each category. And even though every school's different, yours won't align perfectly, probably, some do, but not usually. It'll give you an idea of where you need to pay attention. And if you still have questions, reach out. We're happy to help you analyze that and offer suggestions. So the first thing is cost control, because the higher your cash flow, the higher your company value, which Taylor will talk to you about. You want to have a strong independent management team. So basically you're working your way out of a job. It's like raising your children. Your job is to work your way out of a job. You want to produce a team that can go forward and not have a train wreck if you exit. So investors and buyers want to be sure that the exiting owner is not going to cause, not that the owner causes a problem, but the fact that the owner exits won't cause a problem with the team and with family. So grow your team, give them opportunities. If you have a dynamic team, they'll sort of force you to do that anyway because they'll want to continue to grow. Keep your staff benefits and pay up to industry standards. This is a little bit today preaching to the choir because you can't actually even hire without doing that anymore. We used to be able to do that, but that's not happening today. So be sure that you're keeping up with staff benefits and pay. The flip side of this is be sure that you are keeping your tuition rates at a level that can support that increased price. So I could easily go off on a tangent about what I'm about to say, but I won't. Be sure that you are not using grant funds that will come to an end to support increased salaries. You can do that in the short run, but you need to make a plan for getting your tuition rates aligned with your costs, because those grant monies are going to go away and you need to depend on tuition. The next thing is good record keeping systems. If you're in a process to gain an investor or sell your company, you need to be able to produce information, and you need to be up to date on what types of record keeping systems are standard in the industry today. And also, you want your curriculum and programming to be very high end. There are specialty curriculums, of course. There's Montessori, language immersion, Reggio, religious-based, and of course, there are traditional play-based curriculums. All are fine. Just be sure that it's very strong. There's no place in the market anymore for babysitting. We have to have very strong programs in place for children. External forces that you need to be aware of include buyer objectives. So what I mean by that is, very often when we list a company, their success in selling at a really strong amount depends more on what the buyer's goal is than what the seller's goal is. And what I mean by that is, you might have a particular buyer really wanting that geographic market, or really needing to add on in that market to support their overhead structure, or really needing a key piece of the management team that exists in that company. So even though when we launch processes, we don't name prices, we stopped doing that 4-ish years ago. Because the market continually improves and we don't want to limit our value. So although we coach our sellers on what we expect the value to be, and we coach on a very stable predicted value, we generally go over that value in the process. Large sale transactions in the market affect your multiple. So Taylor will talk more about the multiple, but the multiple gets set by bigger transactions that are being moved in the market. So I'll pick on Childcare. They're our friends. We love them. They're the largest in the country. When Childcare sells, that sets the bar for the multiple under them. So size is one of the criteria that Taylor will talk about, but the larger groups set the bar, and as those multiples increase, everyone's multiple increases. So even though we might want them to do poorly at times, we really don't. When we all win, we all win. We need everyone to do well. Private equity controls a good bit of the assets in our country, and they need to grow. It's in their business model. They don't stay stagnant. They need to grow. So that means deals get done. REIT, real estate investment trust, and individual real estate buyers also drive the market. So when they want to invest in the market and they find the market successful, then we're all more successful in the work that we do. Competition drives your price. So running a competitive process drives your price greatly. So there is a lot of outreach today from buyers directly to sellers. I'd do the same thing if I were them, but largely it eliminates the competitive process that in our processes increases the price on average 22%. So we've been in processes where there was an individual buyer and seller, and then we've expanded that to a competitive process with multiple buyers, and those increase the value on average 22%. So competition for your asset drives prices. Legislation helps drive prices when people are concerned about universal pre-K, or they're concerned about minimum wage, then those things affect value. Those get talked about. We've been talking about those things for 20 years. It hasn't deterred the market, but it gets talked about a lot. And then some of our buyers' ability to secure financing, although the majority of our buyers have cash to spend. And so financing isn't largely a part of the conversation in our buying group. But if you get smaller buyers, then their ability to secure financing might be a bigger part of how successful you could be. So let me flip over to what is my childcare business worth? And I will turn this section over to Taylor to talk us through how he and his team look at business values. And then I'll jump back in with real estate values.
Awesome. Thanks, Kathy. So as Kathy mentioned in the introduction, valuation gets a really bad rap because it is very complicated. And it is complicated because it falls in this gray area of understanding. It's the science of the financials, but the art of understanding the operations and how to quantify all the managerial decisions that you've made to one point in a particular time to create a value. And there's a lot of competing interest out there as far as in the industry that we operate in for the valuation and finance side. In particular, you have the numbers people that operate or that perform these valuations that solely look at historical information, apply growth rates. They want to look at your financial statements, your bank reconciliations, very numbers driven, and put a nice, neat valuation inside of a box and say, this is the valuation. And then on the other hand, you have the storytellers that walk into your operations, that walk into your schools, and they automatically see the potential between your programming, the management team in place, the quality of your teachers, and they see the possibility. They start to sing a narrative of the possibility between 2, 5, 7 years down the road of what can be created. And the gray area happens when these two perspectives try to interact and they talk over each other's heads, because the numbers people look at the storytellers and say that they live in la la land as far as valuation goes. They have no foundational footing. And then the storytellers look at the numbers people and say that they lack creativity. Like they have no imagination to see the possibility of what can be. And I think at Hinge and our team, we really try to challenge ourselves to be in the middle and to be the numbers people that have the creativity and the storytellers that have discipline in the numbers. So we want to really exemplify the art and science of valuation, and we do so by going through a series of steps that will show it at kind of a quick glance, and then we'll kind of take a little bit of deeper dive into each category. So of course, we start with the financial statements. We look at the most recent 12 because we want to have an accurate representation of where the business is right now performing in the market. There are some variations to that, and there's a reason why we look at the first or the most recent 12 months rather than some other variations, but we'll touch on that as well. We want to look at all of your schools within your portfolio at a stabilized value at full maturity. Meaning, if you have a newly opened school, we would pro forma that school out, taking in consideration your enrollment, tuition rates, expense structure, things like that, and come up with a value, a cash flow structure for that school of what it would look like when it's fully stable, 12 months, 18 months down the road. We'll project that out and wrap that into your evaluation. Once we have a handle on the finances, we jump into what are the things that will stay? What are the expenses that will leave in the event of a transition? We start to make some adjustments to your cash flow. We look for a go-forward EBITDA, taking into consideration some non-reoccurring expenses as well as owner-related expenses. All baked in that, we jump into what the real estate looks like. How does that play into account when we're talking about a transition in ownership? A lot of times the owner of the business also owns the real estate. Sometimes it's third-party leased, and that can change how that interacts with the valuation once we come up with our final recommendation of value. And lastly, we look at the external adjustments, meaning that all the other adjustments, we look at what, how are the current operations affecting the expense structure. Now we're going to look at what potential buyers external from the business, how would they impact those adjustments and what adjustments can be made. And then finally, we'll wrap up looking at how multiples play in and what the opportunities and risks are associated with your business and how that arrives at a multiple for our final valuation. So starting with the financial statements, we look for a rolling 12-month financial statements for all mature schools. Again, our goal is to get to a mature level for all of your schools associated with your business, but we look for a rolling 12, not only because it gives us a accurate representation of your current performance, but it in total encompasses the seasonality of your revenue model as well as your expenses, because we know that your revenues and your expenses between summer, fall, and spring do not look the same over time. So if we were to take we're closing out the month of June. So if we were to take the first 6 months of the year and then annualize that for a 2023 number, we would be most likely either overstating or undervaluing your revenues based on your seasonality and your demographics and market, because it's almost guaranteed that the first half of the year is not going to look like the next half of the year, especially within the childcare industry. So we want to make sure that we're accurately representing and taking into account the seasonality of your operations, as well as recognizing the current performance of your schools. And that brings us to, if you have new properties or new schools in operation, we want to make sure that we're maximizing that and fully realizing the value of those schools by representing that with a fully mature and stabilized value. We do that in a multiple of different ways, starting with your revenues, your tuition rates, and pulling out a projection of enrollment. So if your school is newly open for 3 months, let's say, we'll take that trajectory of enrollment as well as other criteria for neighboring schools, especially within the same network. We'll inlay all of that information to come up with a projection of where that enrollment will stabilize, couple that with your tuition, and we have a benchmark with your revenues. We'll do the same thing as when it involves the expense structure, because we see as sister schools, as your portfolio starts to build, there's a lot of commonality and consistency as to how much you're spending on each expense item relative to the income and enrollment. So we can layer that into the pro forma and come up with a mature and stabilized cash flow and have a very well-rounded, stabilized portfolio to start to dig into the adjustments and to find maximized cash flow for the valuation. So once we have a handle on the mature value of your company, we'll step into the adjustment side. And what we're looking for as far as an adjustments, we want to arrive at a go forward EBITDA, meaning EBITDA, we kind of use interchangeably with cash flow. EBITDA is just a very fancy financial acronym for earnings before interest, taxes, and depreciation and amortization. But we will use that as just cash flow. So when we say go forward, we want to take out any expenses that are unique to your operations and your ownership, so that in the event of a transition, those expenses will stay and be excluded from the cash flow that will be transferred over to new ownership and to new operations. So these expenses will most likely include, of course, we'll go over owner's expenses, which is probably the bulk of some of these things, but a lot of professional fees, consulting fees, payroll processing, small things like that, that will be very negligible for a larger owner or a new owner coming in. We'll take into consideration and add those back, as well as capital improvements. That is a big thing, as what Kathy was alluding to, as some of the internal factors that you can be working on today to create value. we extract that large capital expense out of your operating expenditure as a non-reoccurring expense, which in turn creates more cash flow for the current operations. Going back to, or going forward into the owner's expense category, this is where we, in the valuation conversation with our owners, they start to draw back a little bit, because there might be a lot of expenses in here that are related to you personally baked into the business, which is absolutely fine. We want you to be compensated to the maximum value as possible, because at the end of the day, this is your business. I'm not the IRS, and I'm not McGruff the crime dog. I'm not coming to get you because you have your Netflix subscription, the dues and subscriptions line. It's not a big deal. What we want to understand is what expenses will be transferred in the event of new ownership, so that we can fully maximize the profitability and the cash flows for this evaluation and for ultimately the transaction and succession of your company. So what this looks like is compensation, especially if you are W-2 and a director within the company. We will take your salary out and replace that with a full-time director, given your demographic, given the market and area which you operate, as well as other add backs to include anything from a car, cell phone expense, personal charity that you have allocated to the company. Things of that nature will all aggregate and exclude out of the cash flows for our evaluations purposes. And then next, we'll start to look at, do you own the real estate? This is another critical piece that Kathy will kind of give us a breakdown of after we discuss the business, but adjusting the rent is a large portion of what we want to focus on. For a lot of the owner operators that also own the business, it's not uncommon to see that the rent charged to the business is just a break even on the mortgage, which is okay. But for the valuation sake, we like to assume a triple net lease is in place at market rate, meaning that property taxes are included. Most of large or even medium-sized repairs and maintenance are also included into this model, and the rent is reflecting of market value at the current time. So those are all culminations of what we'll take into consideration and adjust that rent number if we need to, as well as add some of those expenses into the operating model in consideration for our evaluation. And then finally, we'll look at the exterior adjustments. So what does it look like for a larger operator, a local operator, or someone that is utilizing this company as a platform within the market? What expenses will stay? What expenses need to be adjusted? Very commonly, we see benefits, health insurance, other insurance be one of the main considerations when looking at a larger operator coming into play. Just with the economics of scale coming in, they are able to provide more benefits at a much lower cost, so we're able to adjust some of those expenses. Management expenses is also another key item of transition of how much overhead is being allocated within the company that is being that's up for sale, as well as what expenses need to come into play from a regional level, from a overhead perspective. And property taxes also are a key player in this, because based on the structure of the acquirer, some of those property taxes might be allocated to other areas outside of the operating P&L. But for this section, before we start to assign the value and look at the opportunities and risks associated with your company, we want to just put on a different lens, a buyer's perspective of your P&L, and try to get at a formalized cash flow number that is suitable for a current multiple in the market. And then finally, we look at what impacts the multiple of your business value in the market today. And as Kathy alluded to, I think a lot of the internal and exterior factors that we talked about earlier really drive the value or impact the multiple that will be assigned to your company. The first two, I think, are probably the most sensitive to the multiple. The number of schools and demographics play a large role in assigning a multiple, mainly because when we were looking at a new buyer coming into a market, the more schools that they have, the larger platform, the more overhead they're able to assume, and effective cash flow they're able to achieve. There's also the quality of real estate and quality of programming. With the investment into your facilities and into your processes and programming, the quality of your enrollment system, your record keeping, your payroll system, things like that allow for a much smoother transition and a much better platform for future operators to build upon. And the quality of the real estate, I think, is a very interesting one as well, because my generation of parents now, I'm a parent of two, we still have more information available to us than any other generation before, especially when it comes to childcare, given the internet and other areas of content. However, we still make very strong judgments based on the quality of the real estate on a roadside perspective. So if we're not seeing the investment being made into the parking lot or the playground or the facade of the building, we will associate a poor quality program, which we know is not true inherently across the industry. So we want to make sure that we're investing in these soft areas for the real estate and the programming system to overall achieve the value and show the quality of programming that the owners are providing. Also, go forward management is something that Kathy alluded to earlier, as far as the internal factors that affect your value. The management and employees at your schools are just as much of an asset as the cash flow that's going to be in transition, especially in today's demand and workforce constraints. Buyers and acquirers and people wanting to get into industry see a strong management team as just as valuable as any cash flow being recognized off of your business. And subsidy is one that has a polarizing perception from a buyer base, but we have just as many buyers within our strong network that seek out large subsidy schools because they understand and they can maximize and they're able to capitalize on that revenue structure, as there are others that feel it as more of a risk. But that is also something that plays into the impact of your multiple going forward. So once we're able to really sit on a strong recommendation of value, we're able to take that analysis further and apply the multiple for the business value. The next step in this is to realize and integrate the real estate value to come up with a fully concluded number for your business in value.
Taylor, thank you. That was fantastic summary. We got a couple of really good questions. So before I jump into real estate, let's tackle a couple. The first one is that there was a comment made that most banks want to see the last 3 years P&L balance sheets and tax returns. And I would just add to that is correct. And in our world, balance sheets and tax returns are not necessary to get your company under letter of intent. Once you have a signed letter of intent, you'll go through a very extensive diligence process, which our team manages, and it's complicated. Also, there's a quality of earnings process that Taylor and Rusty, whoever performed the valuation, jump back in to defend. So in that process, you'll be asked for those items and much, much more. But just for getting a company under contract, we don't require, and investors don't require, any more than your financial statements. As a matter of fact, they don't even see your financial statements until you're under contract. They will only see the Hinge generated financial statements in our format and with our analysis. So, but really good question. Second question is, are COVID performance results backed out in valuation? And the answer is yes. Everyone knows that 2020, and for most people, 2021 was a crapshoot. It's completely irrelevant. Most everyone began to recover in 2021. Most strong investors want to see recovery in 22, and especially now that we're rolling into 2023. Demand for enrollments is very high, and people who aren't full are usually not full because they don't have staff. That requires the delicate balance that I mentioned earlier, which is the aggression that the industry is putting forth on tuition rates to match the rising costs. And I just can't be preachy enough about that your groceries have gone up because it costs the grocer more to buy those now. It is now costing you more to provide the same service. And although I know you're respectful of parents, and I am too, I'm your advocate, and you can't provide a service at a tuition rate that's less than what it's costing you. That just business model doesn't work. So we have to pass those costs along to our customers. So those are the things to look out for. Taylor, anything to add about how people are looking at COVID results?
Yeah, I think you nailed it as far as the COVID results as being backed out, but I think it also emphasizes the importance of not relying on the COVID grant monies even today to prop up your operating model, because those are things that are non-reoccurring and will be taken out of your revenue stream for the evaluation purpose. So I think it's now more important than ever to charge exactly what the quality of care costs, with parents now paying across the board more. They're less sensitive to the price increase because inflation and everything from the pump to groceries are going up. I think now is the perfect time to make sure that you're charging, as what Kathy was saying, what your child care is not only worth, but what it's costing you.
Great, thank you. Thank you, Taylor. Two more. One is, what's the range of multiples for a single school in recent transactions you've been a part of? Great question. I like to always preface that with multiples are important. What's more important is maximizing the EBITDA that the multiple is based on. And that's what Taylor just talked us through. So the very fine art of maximizing that number on a go forward basis to the highest possible value, and then applying the multiple. The range of multiples for a single school, and let me also qualify this by saying that in Hinge transactions, and this is only because our buyers want a certain type of asset. So in Hinge transactions, unless in a very high-end market, our capacities are usually over 100, and they're usually financially stable schools. So we don't deal in assets that might be troubled. So let me give that qualifier. For a single school, that range can go anywhere from 5 to 6.5, with the factors in that swing being the things that Taylor discussed affecting the multiple. Are you in a major market? What's the quality of your real estate? What is your EBITDA? How strong is your team? Are you in a private pay versus subsidy market? So there are many, many factors that go along with setting that value, but single schools would be priced in that range given our buyer base and the size schools that we operate in. Really good question. Thanks for that. I know that the intent is to get the most from our business. I also have spent large portion of my career with the largest player in this industry. But our excellent childcare small businesses still valued as players in the field. Absolutely. You guys are probably aware of the fragmented nature of the industry, and that the top 50 players hold a very small segment of the industry. And if you look at the top 50 in size down to the 50th, you get from a couple of thousand schools to about 10. And there are a few that aren't reported on there, but that just says that everyone else is providing the majority of the service in the industry. And to speak to your question about still valued as players in the field, these larger companies can only perform well when they are able to grow with a combination of new schools and acquisition schools. So even they highly value other players in the market, in addition to parents and other stakeholders and governments that depend on smaller players to provide services for families that they fund. So they are incredibly highly valued. So I hope you feel that, because I would hate to think there was anyone out here doing the work that you guys do that didn't feel valued in the industry. And one more, and then I'll jump into real estate. We'll leave some time at the end. What are some typical percentage increases that are happening out there right now? So I believe you mean in tuition rates, and I'm really glad you asked that question. We have seen that the historical 3 to 5% tuition rate increases that happened in the industry before COVID have jumped to 8 to 12%, and in a lot of cases more than once a year. We also have seen more aggressive strategies with holding current families at a certain increase, and then incoming families being reset at a price that reflects the actual cost of care. What that requires is that you use partially some of your grant funds, hopefully you have some, to offset some of those staff increases until you get to the place where everyone is at the market rate for tuition rates, because we are not going backwards in what we're paying people. That is not going backwards. It will probably continue to increase. So the only long-term answer to keep us viable and healthy is to move your tuition rates to where they need to be. I try really hard to be your advocate. I mean, parents have lots of advocates. I have children who have children in childcare, and I'm very respectful of the struggle for them, but they have so many advocates. If I see one more article that says, oh no, childcare now costs more than college, I'm going to lose my mind. Good. It ought to. We've determined that that's the most critical time of a human's educational development, and that's where we should put our resources. So really good questions. Thanks guys. You guys keep them coming, because I have about 5 more minutes of content, then we'll jump into some more questions. So thank you for that on the business side, Taylor. Okay, we're going to talk about real estate value if you own your real estate. And we get into a lot of conversations about, I had this appraisal done by the bank, and this appraisal, and it's worth this today. If you look at what your real estate is worth just as a building with no business in it, then you can do a traditional appraisal and find out how the market would value that building without the business in it. However, especially if you're selling or you're gaining an investor, you're going to have a tenant with a certain rent in that building, hopefully for a long time. You know, whether you sell the real estate or whether you keep it as an asset and you gain the lease income, and which is a lot easier than operating a business. So it's a move a lot of people make when they sell their business. But with the business in it, with a fixed rent, that rent then determines the value of the building. So you can call it the income approach in a traditional appraisal, but that is completely the driver of the value of the real estate until the time that that tenant is not there anymore. So an investor wanting to buy the real estate wants to know one thing: what is the return on my investment? And the return is the rent stream. So I'm going to show you how to take the rent stream and then calculate what the building is worth, given the fact that it has that tenant in it paying that amount of rent. Taylor spoke briefly about setting the rent. So one of the pieces of our valuation, if you own your property, is to be sure that we maximize the value in your real estate and therefore the rent as much as possible, because for most sellers, that's where they'll get their greatest value. So what you're currently paying yourself, we don't care. Nobody cares. Buyers don't care. Investors don't care. You can pay yourself zero rent or every penny you make, and we're just going to adjust it to a market rate anyway. So that isn't a barrier, similar to what Taylor had to say about your personal expenses. Those things get adjusted, doesn't matter. So what we do is we analyze the real estate, the rent, in multiple ways. So we're looking at industry standards of rent to potential revenue at certain occupancy points. We're looking at it as a percent of the revenue at its current state. We're looking at it as a price per square foot. We're looking at it as cash flow coverage. So we analyze it in many different ways, and then we set that rent as high as possible. So what we're doing here is we're taking that rent, and I'm going to give you an example in just a sec, and we're going to apply a cap rate, a capitalization rate to the rent to calculate the real estate value. And all that says is the investor wants a certain percent return on their investment. So let's say you're going to buy a piece of real estate and you want an 8% return on that real estate. The rent needs to be 8% of what you're going to pay for it. That gives you an 8% return. But we're going to do the opposite. We know the rent, and we're going to divide by the cap rate to calculate the value of the real estate. I will, on the next slide, talk a little bit about where the cap rate comes from, but let's do the math real quick. Okay, first of all, in my methodology, we either know that the rent is fixed at $120,000 a year, or we said in your valuation of your business and real estate, we have calculated that a very solid number that investors can tolerate and will feel good about, and also maximizes your value, in this case, is $120,000 a year. So when someone buys the real estate, again, they want to pay an amount for the real estate that gives them the return they want, the capitalization rate. So next, we take that rent and we divide it by the cap rate. In this case, I've used 7.5%. So if you want to plug it into your calculator, it's 120,000 divided by 0.075. And that will give you $1.6 million. So in this case, if this person knows that they're going to get a rent stream annually of $120,000 and they want a 7.5% return, they can pay you $1.6 million. So, if that didn't make sense, populate the chat. Let me talk a little bit about what determines the cap rate. So as you can see, because we're dividing, the lower the cap rate, the higher your value. The higher the cap rate, the lower your value. So it's inverse. So just know, as we lower the cap rate, your real estate's more valuable. As we increase it, your real estate's less valuable. So the biggest determining factor on the cap rate is who is the tenant and what is their credit. And this very often plays out really well if you sell your business to a larger company or a national company or a super regional company who is very well funded, has great credit, is seen very highly in the market. Then that cap rate can go as low as the upper fives. So, big spread there where your real estate, and this is not a criticism for smaller providers, but your real estate immediately becomes more valuable with a higher credit, larger tenant in your building. It's just like the difference in a local burger joint and McDonald's. Investors feel more secure about owning real estate with McDonald's, who can probably keep paying the rent, even if there's a problem in that building, than a smaller provider who is going to get in trouble quickly if there's a problem with the revenue in their building. So it can go as low as the low fives. Some can go as high as 10. We haven't really seen those over 10, except for troubled assets, in a very long time. You guys see me using 7.5% here. On average, I think if you just wanted to check an average, you could use 7.5%. But again, the range could be, if you want to look at the range, use 6 to 8. 6.5 to 8. I will say that. Taylor, any other thoughts about that?
No, I think that's a great summary, especially for the current state of the cap rates. It is a very large spread. And in addition to the credit, I would also say that where you're positioned in the market also dictates a little bit of that. But right now we're seeing a very wide spread coming off of the massive influx of demand for real estate. So there's a lot of factors that go into that, but it is a very important concept to grasp in terms of valuation for your overall assets.
Great, thank you for that. Couple more questions and then I will keep getting a roll there. Let me go back to the top. Thank you, Tammy. Appreciate you too. To what extent can employee turnover affect the multiple? Everyone knows that there's a good bit of turnover right now. So if you have a stable staff and you've got some long-term team members and some short-term ones and some that tend to, turn over a lot, that's not a problem. If you have 100% turnover, probably an investor or buyer is going to question the management. Excuse me, or whatever else might be related to that turnover. So you can see I chose the bookends. Most people are somewhere in the middle where they have open teaching positions and they have more than the usual amount of turnover. So it doesn't today hugely affect your value. What are the current industry cap rate levels? I think I talked about that. Put another question in if it doesn't seem so. I'm in the process of getting a bank loan to build a large center. He asked for a 1.25 debt service ratio. Can you talk more about that? Yeah, so he wants you to cash flow 1.5 times your debt service. We generally like for them to be 2+ rent to cash flow coverage, and most of our investors like that as well. That's 1.25 for an individual owner is pretty standard, and I think is a pretty good number. That helps you if it's lower than 2. But we generally like to see at least a plan for the ability to make 2 to 3 times. We feel really good about what you're investing in your building if it's 2 times plus. Hopefully that helps out a little bit with that question. Do you use the same valuation for the investor as an owner user buying both the business and real estate? We do. To us, it's the same thing. So we want to use the same valuation because we want to maximize the value for our clients. So that's our job. Our job is to show our client seller in the very best light and get them the very best offer, no matter who the new buyer is. So we would use the same strategy in what we show. And remember that we don't show values to buyers. We don't name asking prices. We present information, and it's the buyer's job to make the decision about what that asset is worth to them, knowing they've just entered a very competitive process. So that's how we get values maximized. So we present the same information to anyone who would be looking at it. But good question. I am making the opportunity available to an investor to become a part. Who can I talk to help me offer the ROI on their investment? Not related specifically to real estate compared to last year has been there. Yeah, so different questions, sorry. Reach out to me. I'll get you aligned with one of the advisors would be on our team. So there's 6 advisors on our team. There are 2 analysts, Taylor and Rusty Bailey, who are both amazing. One of our 6 analysts would be a great fit for talking you through that. And I've got a couple with more real estate experience than some others. So I will certainly align you with the best person to help give you some advice on that. Feel free to reach out. Has there been more transactions or less transactions closing? So more is the answer to that. Although you said not specifically related to real estate from last year, we had a real rush on real estate assets in 2021. We saw a decrease in 2022. And to me, that's a confidence thing. We saw in 2020 and 2021, people lose confidence in holding their real estate and leasing it back, which is fine. We can do it either way. And so more people wanted to sell their real estate and exit everything. And then in 2022, people got a little more confident. And people started to say, I think I'll just hold my real estate. I really like this provider as a tenant, and I like what they're doing with my business. And I don't know what I'm going to do with the money anyway, and I don't want to pay taxes on it. So we saw business transactions increase, although real estate transactions decreased, but probably back to where they were pre-COVID. What kind of profit margin should you target as an individual owner? Corporate owners say industry's 10 to 15%. Not sure that's what an individual owner should target. I really want you to be at a minimum of 15%. In my opinion, in order to start being financially healthy, you need a 15% bottom line, because remember, capital improvements are not recorded there. So you need to reinvest in your business. You need to be financially stable yourself. And I like the range of 15 to 30%. Occasionally we see operators go over 30%, but it's kind of rare. They're usually in a very high tuition rate market and have a very full school. So the thing that impacts your profit margin the most is your occupancy. So anything over 70% occupied, that money goes almost straight to your bottom line. So the biggest factor is where you are with your occupancy. So let's take one more. You guys have great questions. If you're a franchisor looking to acquire a single school that owns its real estate, do you value the operations and separately the real estate and then use the combined value? We do what Taylor described to you. So we impute the rent. We use the EBITDA after that rent for the business value. We use the imputed rent to calculate with the cap rate the real estate value, and then we get one offer. Sometimes they're two different entities. We might have a business buyer and a REIT buyer, but our seller will get one offer and a simultaneous closing. So we present those because they're interrelated, right? You can't do one without the other. They affect each other. One more. Is there a difference in valuation multiples if you're 100% franchise versus hybrid owner plus franchisor? We have not seen that to be the case. It might limit buyers if you're a franchise and you have to stay inside your franchise system, then that's typically an individual. There are some investors who own multiple franchises, but typically it will limit your buyers, but doesn't typically change the valuation or the multiple. And time is up. Taylor, anything that I forgot or that you think is noteworthy for us to end with?
I don't think so. I really enjoyed this content, but I think all these were really great questions to kind of wrap up. What is my childcare business worth? I think it's a great conclusion.
I know. I love this bunch. I don't know yet who you guys are out there because I can't see you, but I'll find out later. And we appreciate you being here. And no matter what your go forward plan is, you are smart to start to think about this stuff the very first day you open your business. So hats off to all of you for making the investment. Call on the Hinge team anytime we can help support with information. Or, when you're ready, we're ready. So we would be honored to work with you guys when the time is right. So thanks so much for joining. Look for the slides. Reach out if you have additional questions, and take care and be well and be financially healthy.